Welcome to Relax with Tax. We've been doing this program, as I said, for dozens of years, and it's endlessly fascinating because, as you know, everybody has a relationship with the IRS and with the state government through their taxes. And the funniest story that I remember from my work at California University of Arts, a guy called up and said, you know, I think I need to see a lawyer about my taxes. I said, what for? Because we don't usually refer people to lawyers for tax advice unless they have some serious problem. He said, well, I haven't filed for 7, 8 years. I said, wow, what's inspiring you to file now? He said, the IRS just moved into a building across from me.
That's something.
Thank you, Tom, so much for your support through these years. We really appreciate it. And I want to thank Keegan and Jill Royson who put this together, as well as Intersection. Thank you.
Thank you, Alma. And thank you all for coming out tonight on a stormy night. Hopefully I can get you some information that will be useful. What I normally do with this is talk about, well, first of all, I'm going to talk about the new tax law. That'll be first. And then we're going to talk about certain areas that I find are of interest to artists, creative folks. And it also, these areas actually are the ones that seem to be audited by the IRS quite a bit. And those areas are going to be auto expenses, depreciation, travel, meals, office and home. If we have time, I might get into hobby loss also. And there'll be other expenses we'll talk about as the evening progresses. Those types of expenses, as I said, do get audited when your return gets pulled for audit. Nationally, about 1% of all returns are audited. However, if you have a loss on your tax return, on your what's called a Schedule C, which is your profit and loss from your business. I have the forms in here, and we'll show you that in a minute. I find that if your loss is $5,000 or more, that there's about a 1 in 4 chance of being audited. So that's high. So that's just something to be aware of. By the way, being audited is not a death sentence. Every one of my clients has survived, has been audited, but it's a pain in the neck. And, you know, the best case usually is that there's no change. As we're progressing through the talk tonight, I will also talk about documentation. The more documentation you have, the better. You always want to have receipts for expenses. If you travel, you're going to want, then I'll get into the documentation you want to have there. But the more documentation you have, the better off you're going to be. You'll feel a lot more comfortable if the IRS comes calling. Again, it doesn't happen all the time. As I say, nationally 1%, so don't freak out about it. But it's just be aware of it. And it also gives you some good practices, too, as far as running your business. One thing you'll notice about this taxes this year is that these forms are different than the returns we've used in the past. The Form 1040, which is number 1 on your sheet there, used to be 2 pages. Now it's 1. This was done by Paul Ryan, who showed us that he wanted to get us all in a postcard. And so they're cramming all of this onto one sheet. However, funny enough, by cramming all this in one sheet, they've created 5 new schedules. So, you know, it's typical. I won't get into politics, but it does seem typical, shall we say. So, in addition to this one-page 1040, then right behind it are 3 schedules that are, again, very common. And all 3 of these schedules used to be on the 2-page 1040. So, less or more is less or something. I don't know. So anyway, we'll get into that. But it is different, and that's obviously the most you'll see that change. Everybody will see it. The new tax law, and when I say new, it actually was passed at the end of 2017. 2018 is the first year that has affected us. It made a lot of changes, and we're certainly not going to get into all of those. A lot of them were business related, and we're talking big businesses, corporations and such. But there are several changes that I do want to point out to you. Basically, probably most of you have not filed yet. One problem is going to be withholding on your taxes. They did change the tax rate withholding schedules in February of this year because they wanted to get money into everybody's hands as soon as it's possible is to build up support and show us what a great thing it is. So what's happened, unfortunately, is that the tables are built on as if your old withholding exemptions, a lot of you will claim single and 1 or 2, 3, 4, or 5 or whatever, and those exemptions were calculated under old rules. And now if you have to claim 5 exemptions, that's a lot of exemptions, especially if you don't itemize your deductions, and we'll get into what itemizing deductions are. So anyway, we're finding that people tend to be under-withheld. And you've seen it in the papers, I think. I saw one stat, I think it's refunds are down 17% and blah, blah, blah. One thing is, it's true that you actually did get that money earlier in the year, and of course if you're a normal person, it's, it's gone somewhere. It's been spent or enjoyed or whatever, paying bills. So that it's unfortunate. But anyway, so be aware of that. You probably want to get your return done as soon as possible to give yourself enough warning, that you may owe taxes, because it could very well happen. Right? That's not to say that it won't. I will say, if you claim only 1 exemption, and you really don't have a lot of income other than a W-2, then you're probably going to be okay, and there's not a lot to get too excited about. But if you claim more than 1 exemption, or if you're married, then it could change your taxes from what you're used to in the past. So again, I think getting ready to get the return filed early is a good idea. You don't have to file it, but at least prepare it and get it ready to go. All right, some changes that we want to point out to you. Standard deductions. In past years, if you were single, I believe the standard deduction was $6,700. This year, it's $12,000, so that's a plus. Unfortunately, they've taken away personal exemptions. And those were, if you're single, you had 1, and that was worth about $4,000 last year. So in 2018, that's gone. So in effect, they've raised the standard deduction by about $5,000, but they've knocked out exemptions. And if you're 1, then you really have maybe just a little bit more negative. You've reduced your income a little bit, but it's pretty much the same. If you have children, then in the past you've been used to getting what's called an exemption for them. Those are no longer around. They have been replaced, depending on your income level and how old your kids are, by credits. And credits are good. I mean, these actually, if you have kids, this is a good provision. Children that are under 17 at the end of 2018, you will give you a $2,000 credit per child, unless your income is very high. So that's good, but no exemptions. And so if you have college-age kids, you would have had exemptions for them in the past. Now you get a $500 credit rather than the full exemption. That's one main difference. I don't know if most of you know what itemized deductions are. Those are personal deductions that are claimed on Schedule A. These are basically medical expenses, property taxes, state income tax, home mortgage interest, contributions. In the old days, you could get miscellaneous itemized, miscellaneous itemized deductions, which employee business expenses were miscellaneous itemized deductions, and they were deductible to the extent they exceeded 2% of your income. So you lost some of them, but not all of them. So in 2018 and beyond, those are eliminated. So no more miscellaneous exemptions, and so no business expenses. Again, you can take business expenses if you have a business that you file on Schedule C, but for employee expenses that are unreimbursed by your employer, unfortunately, there's no benefit for that. One other thing that I want to point out is that these changes I'm talking about here that were made in 2018 do not affect California. California is under the old tax law. So those rules are still the same, and so you could have employee business expenses this year for California purposes. So it's made it just a little bit more complicated, of course, but don't forget that. Another major difference this year, and again, if you don't itemize your deductions, if you're a renter and you don't know what a Schedule A is, then you really don't have to worry about this, but I'm sure some people are homeowners out there. And you may have heard of this, but in the past years, you could deduct all of the property taxes on your house, plus all the state income taxes that were withheld from your check or you paid in through estimated taxes. Plus, there is a personal property tax on your car that you could take as a deduction. That has been changed so that in 2018 and beyond, the most of those deductions that you could claim is limited to $10,000. So that can be a major change for certain people. And there's nothing you can do about it. That's just the rules. So basically, these changes in the itemized deductions are going to affect taxpayers, and a lot fewer people will itemize than have in the past. In past years, about 70% of people did not itemize and just filed a standard form without the itemized deductions. This year, the IRS estimates it's going to be 87%. So it's more than cut in half the people that will itemize their deductions. So that's tax simplification, I guess, and it does, but it makes it where there's just as less things that you can deduct.
Thank you very much for watching. If you would like to see more videos by California Lawyers for the Arts, please like and subscribe to CLA's YouTube channel so we can provide full-service live streaming programs soon. Our channel will be producing videos that cover all kinds of artistic, entertainment, and intellectual property legal issues. You can also find our videos on Facebook and livestream.com.